Hello, welcome back to another video. So in today's video, I'll be covering a few different portions. I'll be covering great companies falling, as well as some AI news and some meme stocks that has been up around 200% over the past few months. So first of all, let's talk about Adobe. So Adobe year to date is down around 20%. Post its earnings report, it is actually flat. The stock is currently now trading at a 21 times of earnings. So for Adobe, the earnings were quite decent. So if you were to look at the revenue went up by 11% year on year. Diluted EPS also beat estimates. It came in at $4.18 on a GAAP basis and $5.31 on a non-GAAP basis. Overall, this was a decent quarter for Adobe. Besides that, Adobe also bought around $8 million of shares this quarter. So what that means is they're pumping all their cash flow from operations into share buybacks. They're buying up a lot of shares. The management clearly thinks that the stock is cheap at this price. Besides that, Adobe also raised their guidance. So guidance beat estimates as well. Digital media ARR growth will be around 11.3% this year, and the GAAP earnings per share will be between $16.53 and $16.58. This puts the stock at around a 20 times of forward earnings. So I think for Adobe today, the valuation is definitely sound. It's a company trading at 20 times of earnings, growing at 11%. This is definitely reasonable. So for Adobe, if you were to look at the valuation today, the valuation is currently at its lowest point in its history. The stock has never traded at below this valuation before. So for Adobe, I think it is a company that is decently priced today, but of course there are risks to this firm. So the main risk for the company is simply just AI. So this is a video that was generated by VO3. So with more AI coming up, with more AI video generative software coming up, with more people using all this different software, this could erode Adobe's moat. So Adobe is quite reliant on both your video editing software as well as your photo editing software. So if AI is able to do both instantaneously for a lot of the normal consumers, then that could disincentivize people from using Adobe. So that is one portion of the business that is weakening. Besides that, Adobe is lagging behind in the AI race. So this has been a criticism by a lot of investors in Adobe today, which is that the company is not actively pursuing AI. So if you were to look at the capex spend over the past few years, they haven't been spending any money on AI infrastructure build out. They haven't been trying to develop this portion of the business, which is to create AI. They likely feel that this could cannibalize their business, and that's why they're not doing so. But in so doing, the company is basically losing out in this race, and this could be costly for a company like Adobe, especially since the company is currently at risk of this AI revolution. So for Adobe stock today, I think the fundamentals are great, but the story for the company is dead currently. This company is one that is extremely consistent. They've been beating their earnings for the past few quarters already. And if you were to look at the revenue chart, the free cash flow chart, the net income chart for this company, it is all moving in the right direction. But the problem is the story is detached from the fundamentals. So the multiple is not low enough for me to be interested in it yet. The stock is still priced for some form of growth. As soon as no more growth is priced into the stock, like Google back in April this year when it was trading at a 16 times of earnings, I will probably look into Adobe a lot deeper. The stock is cheap right now, but just not cheap enough for that margin of safety. The next stock that I'll be covering as well is Synopsys. So Synopsys on one day, after its earnings, it went down around 35%, wiping out a third of the company. It is currently down around 11% year to date, trading at a 33 times of earnings. So for Synopsys, if you don't know what they do, they provide EDA software as well as IP. So your EDA is basically a software that predicts all the different problems that will be faced when it comes to your semiconductor creation. And in this space, there's only two companies doing it. So you have Cadence as well as Synopsys. So it's sort of like a duopoly in this EDA portion. And for EDA, it is typically less cyclical as compared to the broader semiconductor industry. And that's why these two companies, they trade at such a premium relative to the other semiconductor companies. But of course, your EDA is not a direct beneficiary of AI as well. So relative to the other semiconductor companies, this could be a headwind for a company like Synopsys. So for Synopsys, this is why the stock fell around 35%. So the stock fell because the design IP revenue actually dropped by 7.7% year on year. This was because of the Chinese ban as well as Intel pulling back on spending in this portion. So the company is currently forecasting zero contributions by Intel. It is likely pessimistic. and that was the reason why the stock fell by 35%. So GAAP EPS also dropped by around 45%, and their Q4 guidance actually came down as well, so they guided a lot lower than what the streets were expecting, and that was why the stock dropped by around 35%, coupled with the high valuation as well. So I think despite the drop today, the stock is still trading at a hefty valuation. So the shares are still trading at a 92 times trailing free cash flow before the print, and it is currently trading at around 80 times free cash flow as well. So the stock is still expensive. I think the stock is trading at a premium relative to the market. The company is pricing in around $5 of GAAP EPS this year. So that puts it at around a 77 times earnings if you were to account for the EPS this year. So I think the stock is still trading at a premium. So for Synopsys, if you are to look at the valuation metrics, let's look at EV to sales since the company is not optimized for profitability yet. And the EV to sales is currently at its historical high. It is at around a 14 times EV to sales. And a 14 times EV to sales is objectively quite high. Besides that, EV to EBITDA is currently at around 71 times. So the company is clearly expensive. The company is not trading at a cheap valuation by any means, despite this drop. So for Synopsys, this company is incredibly expensive. It is still an avoid for me. The company is suffering from an overreaction, but given the current valuation, it is hard to justify paying up for this company and paying a premium for this duopoly. It is a high quality company by all means, but of course, valuation comes into play as well. When you're paying a 70 times earnings for a company like this, I don't think it is justified unless the company is growing at 20-30%, which Synopsys is not doing at all. The company is forecasting minimal growth in 2026, modest growth in 2026, and it will resume back to mid-teens growth in 2027. So next year will likely be zero growth for Synopsys, and at its current P ratio of around 77 times forward earnings, the company is still expensive. Next portion, I'll be covering the cloud war in the US. So Oracle actually just reported their earnings, and if you're to look at the market share based on all these different companies here, Oracle is currently at around 3%. So Oracle actually reported their earnings a few days ago. The earnings were decent, it wasn't very good, but the stock went up around 40%. And the reason why the stock went up was not because of these earnings here, it was because of this metric. So it is your remaining performance obligation, basically the backlog for the company. And this was because Oracle signed a deal with OpenAI worth up to $300 billion. So for Amazon, the stock is currently now falling because of this news, because investors are fearing that Oracle will take up share from Amazon. This is a narrative that is being pushed around right now. So because of Oracle's amazing report, Amazon is falling. So Amazon is down around 4.3% since the peak a few days ago. And this is because investors are fearing that Amazon will lose share to Oracle if Oracle continually grows at this rate. So I'll be showing you a model for this company to determine whether or not the company is trading at a decent valuation. Let's take a look at the model. So for Amazon today, the fair value is at around $200 a share. The terminal multiple one gives you around $300 a share. I think this one's more reliable. It's your discounted cash flow analysis. So the main theses for Amazon are as follows. So I projected the revenue for this company over the next 5 years. And here are the growth rates for the different segments. And the main thesis number one will be your AWS portion continually growing. So AWS, I projected it at around 19 to 17% growth over the next few years. This number is tied to the backlog growth. So backlog growth has been growing at upwards of 20% over the past few quarters. So I expect this portion of the company to continually grow. This is one portion that is important for the thesis. Besides that, Amazon's margin will also continually expand because of this portion. So the cost of revenue will likely decline over the next few quarters, the next few years as well, which is what we've seen over the past few years. This is because Amazon has already built out their infrastructure. And as their other segments continually grow, like advertising, like for example, your subscription portion, which are a lot higher margin as compared to your Amazon retail business, the company will likely be able to reduce the cost of the revenue and increase the margin for the company. And this forms the second thesis for the company. But a few things to take note, the company is spending a lot of money on CapEx. So if you're to look at the CapEx depreciation as a percentage of the revenue over the next few years, it will peak at around 19% in 2028. So what this means is that the company will have around 19% of the revenue basically put into depreciation, which is not good for the bottom line of the company. But of course, CapEx is all upfront. CapEx will likely reduce over time. So if we were to project this out for the next 5 years after 2029, then Amazon stock will likely be a lot more reasonably priced as compared to the fair value that I have here, which is at around $200 a share. So for Amazon today, I view the company as around fair value. I will likely add the stock when the stock falls to around $200 a share. That's when the stock looks attractive again. For Amazon, it is a decent quality business that is suffering from a narrative that is completely untrue. It is still the largest player in this entire space, and they have a lot of different companies under them, a lot of small companies. And all it takes is for one of those small companies to become large for Amazon to win in the long term. So for Amazon today, I view this company as fair valued, one of the better ones in your Max 7 list. So let's see how this one plays out. Next portion, I'll be covering some meme stocks. So first of all is Opendoor. Opendoor is up around 278% in the past month. The stock is currently now close to around $10. It peaked at around $11. So we're seeing all this meme activity coming up in the markets today. The markets are becoming a lot more speculative, and this is probably a sign that we should remain cautious in the market today. So valuations are high as well. We're currently trading at a 28 times of earnings, and historically this is on the higher side. In April, we traded at around a 23 times of earnings. And currently now we're trading at a 28 times of earnings. So I think there are opportunities outside of the US and China, for example, where the valuations are a lot more reasonable, and that's why you're seeing all your different Chinese equities going up by quite a fair bit. I don't have exposure to all these different Chinese equities yet, but I'll likely look into some of the smaller cap companies there. I think the valuations there are a lot more reasonable as compared to your US companies. Last portion, I'll be covering some of your comments. So the first one, it says, I'm sorry, but I still think one of your mistakes you did was trimming Google. This was further confirmed when Joseph Carlson bought more, not saying he's always right. Warren Buffett got rich not by having multiple positions, but rather a few big winners. He had half of his portfolio in his top 5, one up to 20% in Apple and down 16% in American Express. Those are his heavy weights, and he's perfectly fine with having successful businesses, being overweight, and just kept holding until fundamentals drop. Google's fundamentals did not drop, nor did it drop prior to the lawsuit coming up. Now lawsuit ended and Google was trimmed, I still don't get it. So a few things, Joseph Carlson buying more shouldn't be a reason in this argument here. I completely respect your opinion, but bringing up Joseph Carlson buying more isn't a reason in this argument here. Besides that, Warren Buffett, his initial investment approach was high concentration, small caps, catalyst investing, but he has shifted to compounding machines, he has shifted to more of your predictable companies. And if you have to look at his portfolio as a whole, more than 50% of his assets is not his public equity portfolio. So you have cash, you have all your different other companies like Sis Candy, like BNSL, all these different companies, they are not listed in the 13F that you see. So the 20% Apple stake that he currently has is probably at around 8%. So that's another argument that is probably flawed. I agree with concentration, and the reason why I trimmed Google was to just take some off the table. If the stock goes up, I have my 11% stake, I'll be happy. If the stock goes down, I will be perfectly fine as well because I took some off the table. Either ways, I'll win in the scenario, so it really doesn't matter. So hopefully this addresses the concern here. Next comment, it says, when Monish Prabhai asked Charlie Munger about Credit Acceptance Corp, Munger immediately dismissed the idea as it was not a win-win in the sense that one of the stakeholders, customer, was not participating in the win due to the business implicit in providing auto loans. So I get what you're saying here with regards to United Health. I think for United Health, it is not a long-term hold for me. It's a company in the insurance sector, and insurance companies are typically avoids. But for United Health, the reason why I started adding to the company was simply because the company offered asymmetrical upside. The company was trading at a ridiculous valuation, and that's why I added into it. Your win-lose businesses like United Health, for example, will always have these events coming up every few years. I hope you guys have found this one useful and invest safe.